Welcome to Thoughts on the Market. I'm Serena Tang, Morgan Stanley's Chief Cross-Asset Strategist, along with my colleagues bringing you a variety of perspectives. Today, I'll discuss the future of the 60/40 equity bond portfolio. It's Tuesday, July 16th at 10 a.m. in New York. Now, investors have been asking, is the 60/40 portfolio, which allocates 60% to stocks and 40% to bonds, dead? Well, after all, the last 2 years saw some of the worst returns for the strategy in decades. Now, we think that concerns about this widely used strategies are not unfounded, but definitely a bit exaggerated. Exactly how one thinks about the right mix of equities and bonds within this type of portfolio, though, will need to change. The strategy of investing 60% of the portfolio in equities and 40% in bonds to lower portfolio risk evolved from modern portfolio theory in the 1950s. To succeed, bonds must be less volatile than stocks, and the correlation between stock and bond returns can't be 1, because that would mean a perfect positive correlation between stocks and bonds. And this correlation has been below 1 and low for a long time, because growth and inflation have moved up and down in tandem for a long time. Now, what does this have to do with anything, you may ask? Well, typically, in an environment where equities are rallying on the back of strong growth, inflation is also increasing, which in turn means that nominal yields stay high, dampening bond returns, and vice versa in a recessionary scenario. Now, in both of those cases, the negative stock-bond return correlations is related to the positive growth-inflation correlation, which explains why the strategy of the 60/40 equity bond portfolio worked so well for decades, particularly in the low-vol, high-growth inflation correlation, low stock-bond returns correlation environment of the late aughts to 2010s. Unfortunately for investors, though, this has not been the backdrop for the last few years. The highly unusual macro environment coming out of pandemic broke that usual relationship between growth and inflation, which in turn broke the relationship between stocks and bonds, led to a spike in fixed income volatility, and dragged bond returns to the lowest levels in decades over the last couple of years. But we believe these factors will slowly normalize, which means 60/40-like strategies should work again. While the levels of correlation and bond volatility going forward may look different from history, and definitely different from the QE period, as long as bonds have lower risk than stocks, and there's a little to suggest they won't, bonds will continue to be good diversifiers. But it's important for investors to ask themselves, what could drive correlation between stocks and bonds going forward? Well, longer term, the path of correlation between the two assets depends in part on the relationship between economic growth and inflation, as I touched on earlier. And this is where AI can come in. Positive productivity shocks from Gen AI tech diffusion and the energy transition may change that dynamic between growth and inflation. And at the same time, decoupling in the world's key economic regions as a result of the transition to a more multipolar world could alter the correlation between regional equities and rates. So, will the 60/40 portfolio be the strategy of the future? Or is it going to be more like 70/30 or even 50/50? Slower normalization of volatility and correlation means that a portfolio with more equity could yield better risk-reward than a 60/40 mix. On the other hand, as the world's 65-plus-year-old population continues to grow over the next decades, this aging demographic may demand higher allocations to less volatile assets, even at the expense of lower returns. Or maybe, just maybe, there is another solution. Instead of a simple 60/40-like strategy, investors can look beyond government bonds to other diversifiers in building a multi-asset portfolio with more flexibility. Thanks for listening. If you enjoy the show, please leave us a review wherever you listen and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.